What's going on, guys? I wanted to bring you a quick stock pick of the week. This week, I want to talk about Waitr Holdings. So, the stock ticker is WTRH, and they are a food delivery company. So, in the same sense as Grubhub or Uber Eats or Skip the Dishes, they are a similar type of company. They are focusing strategically on the underserved communities, or the kind of ones that the bigger companies have neglected. So more the kind of Midwest. Let's see, the city, they have like their listing of cities that they operate in right here. So as you can see, it's like Alabama, Georgia, Louisiana, South Carolina, Texas, Mississippi, Virginia, Florida, Arkansas. So it's like these communities that are not the major hubs, like places, like New York and California and even Florida. They have a few in Florida, but they're not like mainly focusing on these areas. They're focusing on the kind of more underserved areas. So also, a lot of these places have a ton of local businesses that are not necessarily giant chains or corporations that don't necessarily deliver through the giant kind of Grubhubs and all these other food delivery services. So, this is an early play because Waitr is definitely up and coming. They're not fully established. So in terms of like whether it's an investment or speculation at this point, it's probably still speculation because they have only proven that they can be successful, at least in generating profits, or I should say revenue, not necessarily profits. They're not profitable yet. And they have recently released their first quarter revenue results or financial results for 2020. So they had a net loss for the first quarter of 2020 of 2.1 million, or 0.3 cents a share, as compared to 24.5 or 24.7 million, or a loss of 38 cents per share in 2019. So it's pretty good numbers to bring towards, or I should say bring your losses down. Now obviously you'd want to see profit, you want to see them to be profitable, but at the same time, going from 24.5 million last year to 2.1 million loss this year is good. It shows that they're generating revenues higher, or at least are getting higher profit margins than they were in the previous year. Their adjusted EBITDA for the first quarter of 2020 was 3.7 million. So that's earnings before interest, taxes, debt, and assets, I think, or something. A stands for something. Who knows? I think it's assets. For the first quarter of 2020 was 3.7 million compared to a loss of 9.9 million in the first quarter of 2019. So that's just their earnings, or I should say earnings before interest, taxes, debt, and assets. So basically, overall, they made about 3.7 million after everything, or I should say before everything. Who knows? That stuff all gets kind of confusing to me, and those numbers are not the ones you should really focus on. It is good to see. You want to see good EBITDA. That's kind of like one of those things that definitely shows that they're on their way to profitability, is having a solid EBITDA. But really, you just want to see increasing revenues consistently over consecutive quarters, and showing that they can be resilient in any market, which they've shown through these results, that they can still be resilient even through the COVID-19 pandemic. They were still able to generate revenues and consistently generate revenues, as they show. The revenues were 44.2 million compared to 48 million in the first quarter of 2019. So they did decrease by 8%. And they say here that the decrease was a result of closures of certain non-core markets along with competitive market pressures. The decrease was partially offset by improved revenue per order for modifications to the company's fee structure initiated in January 2020. Revenue per order for the first quarter of 2020 was $12.94, a 28% increase over the first quarter of 2019. Revenue per order was $10.11. So they basically upped the revenue per order by almost $3 there. So that's pretty interesting. And that shows why they were able to improve upon their profit margins, but they closed a few markets. Basically, they shed a few non-core markets in order to focus more on their underserved customers or their communities that they're seeing more profitability in. So that's what a good thing you want to see a company doing is kind of reevaluating and going in and looking at what's working and what's not working and kind of cutting the losses for the things that are not working, and being able to put more assets into, or more funds or more capital into those regions that are serving you better, so those ones you're seeing more profit in. So their operations and support expenses decreased by 9.8 million, or 27%, to 26.4 million for the first quarter of 2020, compared to it being 36 million last year. And they're just all the rest of these just talk about how their overall costs are going down as compared to last year, and then they talk about how just talk about their kind of lowering their costs and are able to make more money because of their consistently being able to lower their costs over quarters when it comes to things like sales, marketing expenses, and research and development expenses, and general administrative expenses. So all of these things are just kind of like the cost of business, right? Like you always have overhead costs, and these are showing that they're consistently able to improve on these costs, so they're not constantly having to pay so much money to run their business. And that's how you're able to gain better profits, is by lowering your kind of operating costs and then increasing your actual profits. So these, if you want to see their kind of overall numbers, you can go in here. For this point, I'm just going to jump over into an article that kind of gets into this more deeply, and then I think paints a little bit of a better picture for how things are looking for this stock currently, and why I say it's still speculation rather than being a good investment. I'm not saying that it's not a good investment. I'm just saying that it's more of a speculative investment than an actual investment that you're guaranteed consistent profitability, and guaranteed the company has shown you and proven to you that it can be consistently profitable. And this is one of the mergers that they recently announced. So they recently acquired Bite Squad. It's essentially another food delivery app. It serves a bunch of communities that they kind of already focus on, like Arkansas, but also much more in Florida, and even in Hawaii, Minnesota, South Carolina, Oklahoma, Wisconsin, Tennessee. So focusing still on these underserved communities, but branching out more into Florida and even all the way into Hawaii. You're seeing them expanding and being able to acquire companies to further their expansion across these underserved communities that they are able to gain good profits in, and that's why they're focusing on them and trying to shed their assets that are not so profitable in more higher cost areas like California and New York, and even some in Florida, or you can even say Seattle and up in Washington. It's a little bit more of an expensive area to operate in. So this article here is really interesting if you want to go check it out. it gives you a better sense of why the company is a bit of a speculative investment at this point. So he talks about how they pre-announced that their second quarter financial results, and that the stock was fluctuating wildly, up as much as 28% on this was back on July 6th. So this was Monday, I think, of this week. And the stock was fluctuating wildly, up as much as 28%, but as of 11 a.m., it was only up 20%. Today, it's down from those levels. It's back down to like $3 or $3.50 or something like that. But talks about here how the company was founded back in 2013. It's still a young company, and it's capitalizing on this kind of growing food trend in food delivery services, and they have shifted their entire operation model to third-party platforms. He talks about how restaurants have shifted their entire operating models based on the coronavirus. So they're picking up these third-party technology platforms like Waitr, and that's why they're seeing kind of this surging adoption of new customers and new people, because they don't want to have actual face-to-face interactions with people, so they just kind of order on the app, sit at home, and then it gets delivered, and kind of have the no contact, because they'll just leave it at your door, and then you don't even have to touch the person or come in contact with them. So this allows for kind of the whole social distancing and non-contact, no physical contact between customers and clients. So last year, Waitr Holdings revenue in the second quarter was $51.3 million. This year in Q2 was $60 million. Good for 70% year-over-year growth. That's good, but maybe not as much one might expect. And it's probably not enough to explain the stock's better than 1,000% return in 2020. So the stock this year has gone from basically less than 50 cents all the way up to almost $4. And this is why you got to be careful when we're looking at a stock like Waitr, or even a stock like IDEX, like I talked about earlier last week, or a stock like Nikola, or any of these new IPO or recent kind of trends that are just starting to gain momentum. You have to be careful, because a lot of these companies are showing surges in users and definitely becoming more profitable, and being able to acquire other companies is a good sign. But one of the things that he points out, when you go down here, is that first quarter revenue was down 8% from the previous year, and it posted a loss of $2 million. It still had plenty of cash then with $39 million, but it was also carrying a heavy long-term burden of debt at $126 million, and that's massive for a small cap stock. So when you start to look into their actual debts compared to their revenues, they have a pretty massive debt of $126 million. So it talks about how they've increased their cash to $66 million, but at the same time that their debt is the biggest issue here. And as long as they can, adjust their profit margins and consistently see growth in their markets that they're focusing on, these underserved markets, and they could be successful, and that they could end up being a stock that will surge in the future and show you consistent profits. The issue here is they need to prove this, and they need to show this, instead of just promising or just acquiring companies to show you or to kind of buy their way into success. They need to actually show it by being consistent. So at the end of the day, if you asked me, do I think this is a good purchase, I would say it's a good speculative purchase. It's definitely, and that's not trading advice, but I'm just trying to give you guys a good sense of where my brain is at with this stock. It's not one that I'd want to jump on the bandwagon and start to buy shares, especially once it's already surged over 1,000% this year. And if you look at this chart, you see the year-to-date chart. You see down here it was 31 cents back in March, basically, and ever since the coronavirus kind of started to blow up, this stock has just shot up. And for good reason. I mean, they do have a reason for why the stock is seeing good profits and good, growth in users, and it's because of this fear of physical contact and social distancing and all these things. So that this stock has the potential to see increased growth, and if this continues, or if they just kind of are, successful, and people start to say, hey, this is much more easier than going out to eat every Friday night. We can just order on Waitr and bam, it comes to our door. We don't even have to talk to anybody or touch anybody, and we have food every week. Or if that happens, and you can see this adoption in customers, and customers keep going up, and they are still able to generate profits in these underserved communities, and if they kind of take over in these communities and become the de facto food delivery service, then you're going to see serious growth, and the stock could go from $3 to $30. But this is going to happen over time, and if you have 10 years to wait, then yeah, you might be good to buy at these levels. But if you want to see short-term growth out of a stock like this, you need to start thinking about buying dips and waiting for the pullbacks, waiting for it to because I would say it's overvalued at this point, right? It's an overvalued stock based on the fact that they're still not profitable. Even though they made $45 million, they didn't make profit. They're still operating at a loss. So that's something that you need to be aware of. Even though they're showing significant growth, or significant growth in profit margins and all of these things, it's still more important to focus on whether the stock is overvalued, and that's something that I think is definitely something to consider after the surge of over almost 1,000% here. And that's what you need to keep in mind when you start to look at these new kind of popular trending stocks that are just popping up. Is this just people jumping in saying, oh man, this thing's going to go to the moon, but then they start to realize, oh wait, they don't have consistent profits, they don't actually have revenue at this point that can show good profits every quarter. They've just been able to consistently make $40-50 million every quarter, which is great, but if they're not actually profitable, then they're still losing money. And this is where this is kind of at a pivot point, because if it can't generate positive revenue in the next 2 years, then that massive debt burden of $160 million is going to weigh heavily on a stock like this, and you're going to see it start to struggle. But this is the question, and this is why I say that it's still speculation on a stock like this, but there is definitely good upside. And if you want to play it for the short term, I would say wait for a good dip, wait for a sell-off. It'll probably drop back down below 3, maybe 250 is a good area to look for, because you can see the support that it had back over here around 250, and I think that in the long run this could be a potential home run, but it needs to show and prove that it can do what it's been doing, but at a larger scale, which is scaling up, showing consistency, but also the ability to scale up. Sure, they're making acquisitions. Their purchase of Byte Squad was a very telling sign that they are moving forward, and they are growing, and they are hoping to expand and take over these underserved markets and become the ultimate food delivery service to much of the inner United States, and Midwest, and kind of those areas that are not as populated as New York, California, and some of these larger areas. But that also are great areas to focus on, because like I said, there's a lot of local businesses in these communities that can benefit from a company like Waitr and a service like this. And obviously with the growth in popularity of delivery services, with the whole coronavirus, this stock is obviously jumping. So that's why, we've seen kind of 1,000% growth in the last year, but don't think that this thing is going to keep ripping when it's already up over 1,000%, right? We need to see consistent profits and consistent returns before we can declare this thing a home run or declare this thing a sure fire good investment, because it is a trend that I think is a good investment. That's one of the things about this, is that the trend itself and the idea is good. The concept is great, just like with Ideanomics last week when I talked about them and how the idea is great, and if they can actually follow through on a lot of these promises and a lot of the deals that they're signing, then these could be great stocks and these could be great investments. So let's keep these on watch. Let's be cognizant of when they're overvalued and when they're undervalued. Keep it on your watch list, and if you determine you have 10 years to hold this stock, it might be a good investment just to buy whenever. But if you are looking for the short term, I'd wait for a dip and then look to catch it on the next rip. So anyway, that's my stock tip of the week for Waitr, and I hope you guys enjoyed it. I'll come back at you soon with another video, and like, share, subscribe, tell me what you guys think, and hopefully we'll talk again soon. Have a good one, guys. Bye.